Nifty is headed towards 28,000 and possibly in this financial year itself. And this sell-off that you're seeing in the Indian markets might be one of the best opportunity you will get as an equity investor in the times to come. Stay with me, and in this video I'll run you through 3 independent data sets, each of which points towards the same direction. Let me start with the most boring argument, which is the earnings architecture. Markets over any meaningful period of time are a slave to two variables: earnings and the multiple investors are willing to pay for those earnings. That's it. Everything else, be it FII flows, war, crude oil prices spiking up, currency depreciation, political noise, they're all temporary hiccups. They come and go. But if your earnings are compounding, then the multiples tend to mean revert. So let's go with the numbers. Nifty's trailing 12-month EPS is 1138 and the value the market is currently giving it is somewhere between 19.5 to 20 times. Now, to calculate future projections, we will take two possible scenarios. One is a pessimistic scenario and one is an expected scenario. So let's start with the pessimistic scenario. Let's assume पिछला 1.5 साल जैसे निकला था वैसे ही और 1.5 साल निकल जाए, right? So last 1.5 year, Nifty EPS has grown by a mere 4.5% CAGR. So if EPS grows at 4.5% for the next year also, your future EPS will be 1183, right? And because we have only grown by 4.5%, PE expansion तो मिलेगा नहीं. So let's say we get 20 PE only. In that case, your Nifty value is 4% above the current levels. So even in a pessimistic scenario, we are actually looking at a 4% upside. Now let's come to the expected scenario. Nifty's EPS growth historically has been 12%, right? So if you take a 12% earnings growth on 1138, we get a value of 1275, right? So even on a conservative basis, let's assume 1275 pe we get 20 PE. We are looking at a 12% upside from here. But if you take the 5-year median and if you take the long-term average, which is somewhere between 22 PE to 23.5 PE, we are looking at a 24% to 31% kind of an upside. And by the way, 12% EPS growth is actually an average. And because last 1.5 year, we've only grown by 4%, that means in the years to come, earnings could actually exceed 12%. In that case, your PE will expand. But that is an optimistic scenario, and we will not be considering that in this video, because my point is that even at an average EPS growth and you consider a 5-year median PE, we are looking at a 24% upside. Pause on that for a second. I'll give you another viewpoint to look at this situation. The market is currently trading at 19.5 times earnings. The long-term average is 23.5 times earnings. That means the market is valuing Indian corporate earnings at a 16% discount to where it has historically valued them. This is a market which is significantly pricing in for the bad news. So if you were to enter at these levels, you are not buying optimism or momentum. You are buying the gap between the current PE and the long-term average PE and betting that it closes. Not expands, just closes. So here is a question that I want you to sit with. What is it that could structurally and permanently go wrong with India that the market would sustain at a PE which is 16% below its historical average? Not temporary, but permanently. Because temporary bad news does not change the long-term PE averages. It only creates asymmetries and opportunities for investors, and that is what we have to identify. And now coming to the second and more interesting part is the signal from small caps, and nobody is talking about this. The case that I want to make is that small caps or the broader market are generally a leading indicator to where the index as a whole is headed, which is the Nifty 50. So to prove this point, I'm going to take 3 instances from the past. So the picture you see on your screen right now consists of 2 charts. On top, we have the CNX small cap versus the Nifty, and on the bottom, we have the Nifty 50 chart. So my point is, जब कोई भी ट्रेंड का लास्ट फेज चल रहा होता है निफ्टी 50, द CNX स्मॉल कैप वर्सेस द निफ्टी चार्ट इज जनरली अ लीडिंग इंडिकेटर टू वेर एवर द ट्रेंड इज हेडेड. सो स्टार्टिंग ऑफ इन 2021 जब निफ्टी 50 का लास्ट बुल रन का रैली था, you can see that the small cap had already began to underperform severely versus the next bull market that came in 2023, which was the mega bull market in small and mid caps. In the last leg of sell off, the small caps had stopped underperforming. Similarly, अभी जब September 2024 में भी हाई लगा था, the CNX small cap versus the Nifty chart had stopped outperforming. So it was a signal. So where are we right now? As we know, 2026 has been terrible for Indian equities, and the last month, which was March 2026, was supposed to be the worst month in terms of FII selling, be it currency depreciation, news inflow, commodity prices spiking, or macroeconomic news. Kuch bhi le lo, it was the worst. But in this last 1 month, something very interesting has happened in the CNX small cap versus the Nifty chart, where the CNX small cap has stopped underperforming the Nifty. In fact, last 1 month mein, it has outperformed the Nifty. CNX small cap versus Nifty का chart last week of Jan में उसका low बन गया था, and we have never visited that low. So this also is a potential sign. Now, because we have two solid data sets in our favor, it makes sense to look at the long-term technicals in order to identify patterns and how markets have behaved in situations like this. So in front of you is the line chart of Nifty 50. This is the weekly chart, and I've plugged in the 100 EMA, 200 EMA and RSI on this. So as you can see, the 100 EMA has been breached, which by itself is a rare phenomena, but we are now approaching the 200 EMA. The 200 EMA has been reached or breached only 4 times in the past, including 2008 and 2020. And abhi ka jo situation hai, that is not half as bad as 2008 and 2020, especially given the current news flow. Kuch aur develop ho jata hai, to that is secondary. But currently, we are far from anything like that. And even the RSI is at 27.8. A sub 30 RSI has only been achieved 3 times in the past, again including 2008 and 2020. So even the technicals suggest that we are possibly around the corner of this market cycle. Now, because there is no such thing as free lunch in capital markets, I'm going to highlight 2 very relevant risks that I can see right now in the markets that could potentially destroy our thesis. The first is sustained crude oil levels of more than say $120 to $140 a barrel. Because what this would do is this would create a lot of inflationary pressure right now. And if we get into an inflationary pressure, the Fed would be forced to go into a rate hike cycle, and so will the RBI. And at the current juncture, if we also fall into a rate hike cycle, the market would really not like it, and it would be very difficult for equity markets to outperform globally and in India both. So this is one very relevant risk that I see right now. The second risk is that the rupee begins to depreciate more than 4-5% on a consistent basis. Because 4% depreciation to market has factored in, that has been happening for the last 50-70 years. But a 5-6% का depreciation is something new. This happened last year, and 2026 में तो 3 महीने में ही rupee has depreciated by 5.5-6%. अभी last week में थोड़ा appreciate हुआ है because RBI has instructed banks to offload the dollar positions. But if we depreciate by 5-6%, this will increase FII selling. Also, one thing, interesting thing I want to tell you about FII selling. FIIs have not started selling last year. FIIs have been sellers since 2022. उसके बाद 2022, 2023 का bull market भी आ गया है. But what is different right now is the speed of FII selling, which is concerning. And also because they have an influence in the FNO market, this is what creates further volatility. So these were the risks that I wanted to highlight. But here is an intellectual point that matters the most. Risk is not the problem. Mispriced risk is the problem. What we are looking for always is asymmetry. When probability distribution is skewed in our favor, or when risk to reward is skewed in our favor, or when the market is behaving way more pessimistic than the underlying fundamentals justifying it. That asymmetry, when it exists, is the only legitimate edge that you and I have as investors. Keynes called it animal spirits, Schiller called it narrative economics. What both were describing was the gap between actual risk and perceived risk. Our job is to find this gap and act on it with conviction, not when things look comfortable, but precisely when they don't look comfortable. This is not speculation, this is the entire point of active investing. Thank you so much for watching. I hope this brings in some clarity in the current market situation and what the next fiscal year could potentially look like. I run a firm called AVN Capital, and I have access to almost all kinds of financial products and services under the sun. So if I can help you in any which way, feel free to reach out to me on any of my social media handles. The details are on the screen, and I'll see you in the next.